Hello and welcome to CMC Markets Trading Outlook for the week of April the 6th, 2015. My name is Colin Szyszynski, Chief Market Strategist. This week our theme is employment, RBA, and Greece in focus. There's a lot of moving pieces going on this week, but it's bookended by employment reports from the United States and Canada. There's not as much data as we usually see, or certainly as what we had last week, but some of the reports that are coming out and some of the developments we may see could still be particularly significant. As I said, the week kicks off with the U.S. Employment numbers. They actually come out on Friday, which is a holiday, and exchanges are closed in most countries on Friday the 3rd. So really, a lot of traders aren't going to get their first crack at reacting to the results until Monday the 6th. And because of that, we could see the early part of the week dominated by the reaction to the U.S. nonfarm payrolls report, particularly because the ADP payrolls report missed. That had sent the U.S. dollar lower, and also the action, whatever happens, could impact the U.S. indices as well. So I'll speak to that in a few minutes. Plus, we still have in Europe, there's less data, but there's still a strong focus on what's happening with Greece. There has been rumors going around that have been denied that Greece could run out of money, perhaps on Thursday the 9th, perhaps on another day this week. So we could still see a lot of back and forth in negotiations. It may not be nothing may come of this, but at the same time, something big may come of this, so we need to be aware of it. We also have other central bank meetings this week. We have the Bank of Japan and the Bank of England meeting, and a lot of other things happening, and the Reserve Bank of Australia as well. So there's a lot going on this week, and that could have a significant impact on trading. I'm going to start off with crude oil and crude oil markets. Here to wrap up the week on the 2nd, we have more steps towards a nuclear deal for Iran. The details still need to be sorted out, and they could be sorted out over the next few months, but it looks like some real progress has actually been made. Well, what has this done is send crude oil Brent a lot lower, and even relative to WTI. The Brent has for quite some time now had a political premium built into it over WTI, because Brent is obviously represents the European price, which is closer to the Middle East, particularly as the U.S. has moved more towards energy independence. The Brent price is where we've seen political risk in the Middle East playing out. Certainly a nuclear deal for Iran could ease a lot of political risk, and what are we seeing here today, in fact, where more recently we've seen the spread between Brent and WTI at around $10. Today it's at around $7. This gap is starting to narrow. It may continue to narrow in the week ahead. So that's quite significant. Overall, for crude oil market, it's been great for trading. As we can see here with Brent, the trend has been pretty much range bound since the beginning of the year. In the case of Brent, from 45 to 62. In the case of WTI, it's about 42 to about 55. But regardless, but within that, we're getting some really good intraday and between day moves of 2, 3, 5%. So fantastic market for trading. The crude oil market may continue to be actively traded right through the current week. Not only even if Iran goes to the back burner, there's still the issue of supply and the supply war we had last week, where one day the crude oil price shot up on news that the U.S. had slowed production, and then the next day it went back down because the Russians increased production. And then that's one of the problems we have in the crude oil market right now, is that we have everybody's worried that if they cut production, that somebody else would just step in and fill the gap and steal their market share. That's what this market share battle is all about, and this could take a long time to resolve itself. So we may see crude oil markets remain active for quite some time. Interestingly, even with Brent oil weakening here, we see a pretty substantial long position with top clients 89% long on Brent. This compares with WTI, where people are a little bit mixed on position value. Clients are 50-50, and we're seeing the WTI sit in the middle. So what does that mean? It means that if we do see crude oil drift lower, Brent could be more vulnerable than WTI here, and we could see that gap continue to close. Speaking about political risk, we'll take a look at the gold market while we're here. Gold can be impacted by three things over the course of the week. The This rally here that we've seen in the last few days in gold has been propelled partly by growing political risk, perhaps surrounding Greece, perhaps surrounding Iran, but also by the quantitative easing program by the ECB as they start to ramp up their money supply has been supporting the gold price. We've got it back up above 1,200 here, and even with the Iran deal, gold has not budged. Gold has held 1,200, so gold is clearly trading off of other factors than Iran. So that's significant. Also, if the non-farm payrolls were to miss and the U.S. dollar were to drop back further, that also could provide a tailwind for gold here. So a few things there moving around. Now I'm going to move to the U.S. markets, and we'll start with the U.S. 30. Something I wanted to show, by the way, while I'm going through the markets here, that you might have noticed is I've changed the format a little bit of today's presentation and the format of my screen. And the reason is because we've recently come out with a new feature on our next generation platform called module linking. And what this enables you to do is to link together the different modules so that when you change one, you change all of them. So I here have linked my currencies watch list into a green group, my commodities and my indices. I've linked them with my long-term chart for a 1 minute chart to show what's going on today, and client sentiment. So every time I click on something, all of these change as well. It's made a huge difference in my work here, and it make a huge difference for your trading. So I recommend everybody learn how to try it. It's this you use this feature here to link the modules, and you can have different colored groups. There's blue, there's green, there's yellow, and there's orange. So 4 different groups where you can link modules. It'd be a huge help to your trading, I think, and it's been a huge help for me, and just a fantastic addition to the platform. So I hope everyone takes the opportunity to learn about this and try it out. Moving down to the US 30, we can see we've got indecision in the market again, a moderate short position in terms of position value, but a slightly higher number of clients. So what does this mean? Well, the bears are taking on a little bit bigger positions than the bulls here. There's a little bit more conviction on the bears side. But overall, what are we seeing? We've had a huge run in the US market, got a double top here, and we are seeing things start to weaken. Interestingly, back here, if there had been a negative payroll number, people would have said, oh, fantastic, it means the Fed's going to delay, and let's drive the market higher. And instead now, what are we seeing? Well, the market isn't driving higher on negative economic news. It's actually drifting lower. Why? We're heading into earnings season. The concern about negative economic news now is how it could impact earnings. People are already worried that, and we already saw hints last quarter, that the rise in the U.S. dollar could impact the earnings of U.S. companies when they translate back their foreign operations. We've seen it in big tech, and it's starting to further away at U.S. earnings. Plus now, we've got the concern of overseas economies that are soft. China, in particular, has been showing signs that it's going off the rails, and the PBOC has had to step up to prop up the economy. Europe is still soft and sluggish, and so then if you start to see the domestic economy soft and sluggish, that could really impact earnings and guidance for the upcoming earnings season, and that's why we're seeing it start to drag on stocks. People are starting to get worried about that. We're seeing it in the Dow, and we're also seeing it in the S&P. Again, 50-50 pretty much on sentiment here. People aren't sure which way to go. The basic trend is sideways, but these descending triangles and these double tops are telling us we've probably put a top in place here, and we could be vulnerable to more of a correction. In the case of the S&P, perhaps back to the 200-day around 2015, this Fibonacci level around 2005, or around the 2000 level, even the round number. The next market I want to take a look at is Australia. Australia, the stock market is looking pretty similar to what we've seen in the U.S., where we had this big rally, a double top, and a leveling off here. But more significantly, importantly, I want to take a look at the Aussie dollar, because we do have the Reserve Bank of Australia coming out with their decision this week. And some people are asking, well, will they cut or won't they? The consensus is that they won't. But the Aussie dollar's been under pressure. The economy remains under pressure, with iron ore continuing to break down. 52-week low for that. Copper's been sluggish. China's been sluggish. So people are still concerned about the Aussie dollar. The Aussie dollar has been dropping over the last a couple of weeks from 79 cents down closer to 75.50. You're getting close to that 75-cent even round number that RBA Governor Stevens has suggested he would be comfortable with. Now, what we'll be watching for this time is, does the RBA decide they need to cut again to prop up the economy? I'm thinking no, but they may leave the the door open to more cuts in the statement. The other question will be, will he try to talk down the dollar further? Previously, he had been comfortable with 85 cents, then 80 cents, now 75 cents. Will he now become more comfortable with 70 cents? Who knows? But something we should be keeping an eye on here with the Aussie dollar. We could see quite a bit of action around the RBA meeting and the statement. At the end of the week, we get a employment report out of Canada, and Canadian employment could be particularly significant. Something that's interesting here, while the price of crude oil has crashed, Canadian stocks have been holding fairly level. And we've been seeing that in other data points out of the Canadian economy as well. Bank of Canada Governor Pallaz recently said that he said the Q1 Canadian economics performance was atrocious, but it hasn't really shown up in the data yet. So we're wondering what he's seeing. And that's why this Canadian employment report could be particularly significant. Are we going to start to see real signs that the impact of the oil price crash is really starting to bite? Clearly, it should be hitting employment in Alberta and Saskatchewan and the other major oil-producing regions where we've seen big cutbacks in drilling activity. And important for us to remember that for Canada is how does it manage and work through the trough? You've got an immediate negative hit from the oil price crash, but there are positive benefits from the lower loonie and lower energy prices, but those take longer to manifest themselves. In the interim, you've got to manage your way through this low patch, and the question will be: is employment going off the table, or is it holding up? How much pressure is on the Bank of Canada to then perhaps cut interest rates at its next meeting? So quite significant here. We've got the Canadian index trading between about 850 and 890 right now, but really the key one to keep an eye on is dollar CAD. If we come down here, we'll see that dollar CAD has actually been forming a top. In fact, there's a triple top here, which suggests that the U.S. dollar might be topping out against the Canadian dollar. The loonie might be starting to strengthen, or at least it looks like the loonie is base building as the U.S. dollar levels off here. As we know, the U.S. dollar has started to weaken a little bit against some other currencies. This range is about 123.70 up to about 128 even, and this midpoint is in and around 126 and a bit. 50-day moving average around 125.50. RSI has been drifting, upward momentum fading. If we did start to see this break under 50, would suggest the potential for a downturn in dollar CAD. Other factor driving dollar CAD is crude oil. As this has gone up, of course, mirrored the crude oil price going down, and now we're seeing it bottom out and level off. In fact, if I just very quickly show CAD dollar, you'll see that doesn't this look an awful lot like what's happened in the crude oil market? So we'll be keeping an eye on crude oil as well, because here the loonie does look like it's been base building lately. I'll now just move briefly to Europe, where we'll start with the Germany 30. As I noted, there's a little less data coming out of Europe this week, but it's had a pretty good run here. Minor double top, looks like it's trending sideways in and around 12,000. As I said, the biggest thing would be Greece, and that's nothing could happen, something huge could happen. It's hard to say, but traders just need to be aware of the fact that that's potentially something could happen. The euro dollar here it has leveled off. It's been under a lot of pressure lately, and this is between the QE program from the ECB and the Greece risk. So a lot of that's probably already priced in. It's consolidating here between about 107 and 110 for euro dollar. The last market I wanted to talk about briefly is the UK. And we do have a Bank of England decision this week, but likely not much is going to come of it. We're in the middle of an election campaign now. The election result is uncertain, and so therefore the Bank of England is very unlikely to want to rock the boat at this meeting or the next meeting. The election is on May the 7th, and really we may not see them do anything in the June meeting either, depending on what happens. It looks like they'll probably be a while. The sterling looks like it's trying to level off here, but as we've seen since last summer, the first wave of political uncertainty from the Scottish referendum, and then the strengthening of the U.S. dollar, and now another wave downward with the election uncertainty. So we are still seeing it's trying to bottom out here between about 147 and 150. The RSI is kind of bouncing around. It's uncertain. It seems as though it's trying to go into a sideways trend, but it hasn't been able to yet. Election risk is still out there, could still weigh on sterling over the next month or so, and we could still see some volatility depending on what shows up in polls. So This week we look like we could have another active week for trading. It's not just necessarily data driven. There's a lot of other news out there that could influence the market as well, and we could see some active markets for trading.